On today's Hot Sheet, I'm discussing Friday's job reports, which shook things up across all markets, housing inventory data for the week, and a report on state percentages of equity-rich homes. Today is Monday, August 4, 2025. I'm Byron Lazine, and the Hot Sheet starts now. Live from Connecticut into August. August, one of the can't wait for the month to get over with months of all time. Just an all-time in-betweener month. It's like, okay, done with summer, ready for fall, ready for, kind of that true start of the year. Real estate agents, you only have 3 months left to make an impact on your bottom line in 25. The year's wrapping up. That's why I love September, October, because it's all new year planning. The smart agents, the smart team leaders and brokers, they get it. Managers of office, your planning starts now. I mean, August is such an in-between nothing holiday month. You could start it now, but there's 3 months left to impact the bottom line of 25. There's a lot of things changing over the next 5-6 months as the year closes out. What is going to take shape economically? What are we going to be going into in 26 with rates and all of that? We had a big mover on Friday with a jobs report. A whole bunch has happened here with jobs. You don't have big revisions like you had in the job report on Friday, outside of you had a big one in 24. Okay. Seems like that 2024 one, we talked about it here, didn't get the headlines. This one did. Okay. Obviously different president in 24 than in 25. And then you got to go back decades ago to get another revision like that. It brought, to me, I didn't understand last year. I'm like, hey, I don't get these revisions. How can they be so inaccurate? I didn't understand in 24. It's like, why are we putting so much weight on a job market that in 2024 was being fueled by, a ridiculous level of government hiring? To me, that was not an indication of a strong economy. In fact, to me, it was an indication of a weakening economy, one that was being propped up. And so you started to see this whole debate here over the weekend on this Bureau of Labor Statistics. I think Trump actually fired the person that runs this data. Chamath Palihapitiya was on X saying these non-farm payroll, the BLS stats, Bureau of Labor Statistics stats, are total garbage. Actually asked Grok. Let's check in on the conversation between billionaire Chamath and AI Grok. Hey, Grok, go look at Bureau of Labor Statistics website for their non-farm payrolls data. Tell me how many times their original forecasts have been revised since January 2020. And of those revisions, how many times the data was revised up versus down? Categorize this during Biden versus Trump presidencies. Bottom line is the BLS isn't so much conspiratorial as it is inadequate in its approach. Okay. So, you've got some partisans saying, oh, it's because Trump's president or because Biden's president. When what Chamath is saying, no, they're just inadequate. They're not good at what they do, which seems odd because there's so much technology. He goes on to say they are all over the place and add little directional signal. They constantly revise and in both directions. So Bureau of Labor Statistics often gets the data wrong. Often they make huge mistakes, which to me, still, just like I was puzzled in 24 by this, I'm puzzled today by this. The sampling techniques they use are brittle and don't work for a large and dynamic economy like the U.S. And so Trump fired the head of the Bureau of Labor Statistics This is a critical aspect of the U.S. economy. Think about this. This comes out Friday. If this report was just 3 days earlier, there's a lot in the, that believe if the report was 3 days earlier, you get a cut from the Fed, not a, no change, which is what we got, but you actually get a cut. I think Logan Monashami over at Housing Wire, we're going to check in on his obviously inventory report here in just a second. I think he said this on X. At one point he said it over the weekend here on X. You would have had a cut if this report came out before the meeting. Now, the markets, CME Group and Poly Market reflect that thinking. Okay, so this flips. This was under 50% before Friday. Now 71% chance from the Poly Market, from the DGens betting on this crap, say 71% chance that there will be a 25 basis point cut on the September meeting, post job report. CME Group has it at 85%. Okay, very strong probability from the CME Group. Pretty conservative in their approach. As you get closer to the meeting, obviously the meeting's not until September. The CME Group one gets deadly accurate. 85.7% chance now that there will be an ease, all based on this jobs report, on the big revision of job growth that we saw. So let's dig into the report a little bit more in case you missed it. I can't imagine you missed the headlines. Here's some other numbers outside of the report. Non-farm payroll employment changed a little in July, 73,000. Here are the 2 months. It's May and June's revisions down, which everybody was reacting to. It's these 2 months right here. Obviously, you have government hiring not at the level it was in 24. Unemployment rate remains at 4.2%. So some of these other numbers on employment are strong. Unemployment, for example, and then the July number coming in unchanged. But this revision downward here in May and June was the big number that everybody reacted to, and it's creating a lot of concerns now. The downside risk that Jerome Powell talked to on labor. Okay, this moves the rates more than anything else that we've seen, right? Always talk about labor over inflation. Look at what the 10-year does. Okay, we're at the lowest point for the month. We're back down to 4.2 off of this news. You also saw the 30-year fixed over on Friday after the labor report come down to 6.63. Look at this. You haven't seen this all year, where you actually have the weekly number. I'm gonna have to move that. Hold on. We've got this weekly number from Mortgage Banker Association. Okay. Coming in. Let me go back, get this thing straightened out here. You have this weekly number from Mortgage Banker Association coming in at 7.01 because we got the whole week. Friday is when this changed the most. All of a sudden, my screen doesn't want to refresh. I'll get it here in a second. But 7.01 was the weekly Mortgage Banker Association 30-year fixed number. We end the week at 6.63. I haven't seen a spread on the chart between the weekly and the daily all year look quite like this one on this past week from Mortgage Banker Association. It was wild. It's not coming back up for some reason for me, but if I get it up, I'll show it to you. All right. So the gap between the two was going in opposite directions. You get the weekly on Friday. It just so happened that obviously this Friday, you also got this low daily survey number at 6.63. This is all in reaction to this weakening job job data. Okay. Logan also, I want to bring up, I think it was, yeah, I'm going to bring it up in the next report. Brings up what we should be watching for in the labor market. So let's go over now to inventory. We'll continue, obviously, to watch, what happens with jobs. There's going to be two major job reports between now and September. So this is one of two. This is not a good one. It's good for long-term rates, but maybe not good for where we're heading with the greater economy. And this is going to be something here to watch for: residential building construction employees. Okay, so if we have a weakening job market and we already have builders who are just getting crushed by rates, okay, could builders maybe help themselves out a little bit with rates by starting to peel off construction employees? Okay, every time they start laying off, essentially, or hiring less, residential construction employees, reducing employee count. Every time that happens, go back to the 90s, early 2000s, the recovery. What follows is recession. You see the same trend line in COVID, but that was very short-lived, obviously. And right now, you're starting to see, a little bit of friction on residential construction employee count. Hey, builders are in it right now. They're in the thick of things. Home tours are down. Activity is down. Their confidence is down. Housing starts are down. Not going to probably need all the employees. And if this number starts to move down, you will see a lot calling for, is a recession coming? You'll start to hear the R word pop back up significantly. And this is why the administration right now is so focused on rates. If the rates do not move down, that gives breathing room for builders, gives breathing room for a lot of companies, gives breathing room for the economy. If rates don't come down heading into 2026, there's a lot to be concerned about, okay? Because how deep could a softening labor market actually get, okay? Over the weekend, President Trump tweeted out that he is banking or projecting, rather, I'm paraphrasing because I don't have the tweet in front of me, projecting that there is a boom in 2026, a boom market coming in 2026. Now, 2026, of course, is America's 250th birthday. Okay, so America turns 250. President Trump turns 80 during the same year. Haley's laughing. Haley, what does that sound old to you? And you've got a whole bunch of stuff. You got what the U.S. Cup, the World Tour, something, the World Cup, whatever the hell the soccer thing is, coming to the U.S. You got all this stuff happening next year. This administration wants a boom year right before midterms. Okay, the last piece of the puzzle is going to be those rates. If you don't get those rates and you start to see now layoffs and a reduction in labor, that'll bring lower rates after the fact. But lower rates could save some of that, because if you have layoff, it takes companies time to recover. Okay. Mortgage rates have already been in recovery phase for quite some time. You do have 13 consecutive weeks of double-digit year-over-year growth, 26 straight weeks of positive year-over-year growth as we enter this week. So lower rates get down to 6%. Future looks bright on that data. All right. Let's get into the inventory, and then we'll take a look at some of the pendings here over the week. Still looking for inventory to increase throughout the year. We did get another increase this week. The difference between this week And the same week last year is starting to shrink. We were up over 30% for quite some time. We're now 27% year over year. We had an increase of just about 860,000 single family active homes on the market versus 865,000 active homes to end the week. Okay. Last year, same week, we're at 683. So just about 180,000 more single family homes active on the market than we had this year. That's 27% more. We're well above the lows of 2019, which was a pretty normal market. So inventory continuing to increase, not at the same rate that we saw inventory increasing in late summer and early fall of last year, but still on the incline. How long will that incline last before we get the seasonal decline? Does a lower rate potentially absorb some of that inventory here late summer, early fall? New listings, nothing crazy, 69,000, near 70,000. Pretty good number, I'd say, from where we've been all year, just about 70,000. We were at 67,000 for the same week last year. Nothing outrageous. Remember, during the recovery, we were seeing weeks where we had 250,000 to 400,000 during the GFC. We're nothing like when we talk about, hey, a weakening job market or a potential R word or a weakening economy. The housing market, while it's been in a recession for 3 years, is nothing like 2008. And we are a far stretch away from anything that even resembles that. Price reductions coming in at 41.7%. It is a high mark for the last 4 years. Outside of the very end of 2022, we may get above that number here late this year. You would see typically a third of homes reduce price before selling in any given year. We're closer to 42%. Last year at this time, we're at 39%. So the sellers that want to sell have to make real adjustments in this market, as there is a buyer who's taking longer. There's more, so that June report, highest cancellation rate, all this kind of stuff is happening, impacting sellers' ability to sell quickly into the market and price sensitivity, obviously, from the buy side. Weekly pending sales comes in at 68,000. This is U.S. single family versus 66,000 for the same week last year. If we look at overall homes in contract, we're at 386,000 versus 379,000 last year. So running at a little bit healthier rate than last year, although we have highest cancellations ever recorded in June. Closings are taking a little bit longer. We're still running just below last year's closing rate. So we need the extra pendings to get to the level of closings at just basically the bottom level at 4 million there. So, all right. Could see 6% rates in the future. We'll see what kind of happens here with this job data, but we're getting closer to 6%. We're at near year-to-date lows on mortgage rates. That's the good news about the labor report. And we'll see how that impacts the inventory that we just reviewed in the coming weeks. All right, mortgages in 2025. As we review this with this ATTOM data, we're going to take a look at percent of equity-rich properties for Q2. Okay, so here are the equity-rich mortgages by state. The mortgage equity for 2025 in Q2 shows that 47.4% of mortgage residential properties nationwide were equity-rich. That's up from 46.2% in Q1. Let's take a look. An equity-rich mortgage is one in which the combined loan balance is no more than half of the property's estimated market value. Okay, so Vermont sits at number 1. New Hampshire, Rhode Island are in the top 3. Northeast dominating the top 3. And one of the reasons keeping the prices, the perceived equity high is those prices and its lack of inventory there. Montana's 4, Hawaii's 5, Maine 6, Massachusetts 7. So 5 out of the top 7 Northeast, California 8, Idaho 9, New York 10, Jersey 11. So now you're at 7 of 11. Not the place that you get slushies at, Haley. 7 of 11 is Northeast states for equity rich. Washington, South Dakota, Utah, Michigan, top 15 to round out. Wisconsin, Tennessee, Connecticut, Oregon, and Texas. That's your top 20. If we go to the bottom of this list, listen, there's winners and losers and everything. Iowa, North Dakota, Louisiana. Sorry, you guys are the losers in equity rich mortgages. Oklahoma and Alaska can throw you in the bottom 5 as well, per the ATTOM research. Okay. Now, if you look at, let's just take the bottom, Louisiana, 50th in equity rich, only 18% of mortgages were perceived as equity rich. North Dakota jumps up to 30%, 49. So Louisiana struggling the most there on this analysis, this equity rich, and this was a rebound in quarter two. Quarter two you'd expect a rebound to happen, obviously, as that was the spring market. Louisiana is actually facing underwater homes. The states with the smallest proportions of seriously underwater homes were also the equity rich states: Vermont, Rhode Island, New Hampshire, Mass, Hawaii. Highest share of underwater homes: Louisiana, Kentucky, Mississippi, Iowa, Oklahoma. Out of the 110 large metros with sufficient data to analyze, the lowest rates of seriously underwater homes: San Jose, San Diego, Boston, Providence, Worcester, Mass. And the highest rates of seriously underwater: Baton Rouge, New Orleans, Jackson, Mississippi, Lexington, Kentucky, Little Rock, Arkansas. Okay. All right. Still nowhere near level nationwide of underwater homes. Here's the definition. Underwater homes, a loan to value ratio of 125% or above, meaning the property owner owed at least 25% more than the estimated market value of the property. And then again, equity rich was loan to value ratio of 50% or lower, meaning the property owner had at least 50% equity. Okay. So seriously underwater. If we look at those numbers too, by the way, I just want to kind of give an example. I mean, you got areas like Baton Rouge, 11%, New Orleans, 9%. But then in the top 5, Jackson is 6%, Lexington is 5.2, Little Rock is 5.2. So kind of low numbers. Louisiana, again, being the one outlier at 12%. That's starting to, that one's creeping up there, but relatively safe spot for, most of the other states on the list. Okay. 10 years starting the week, again, 4.216. It's the lowest level we've seen in the last 30 days. It's the lowest level that we've seen in the last 90 days. And it's not quite the last level of the last 6 months, but it is one of the low levels of the last 6 months. We've only been down here a few times. Stock market is bouncing back after Friday's sell-off. So stocks are moving up 300 points higher. So I don't know. I thought maybe we'd come in today and see some more selling, but traders coming back into the market. Maybe not as concerned. The new round of tariffs, the jobs, they're coming back in. Okay. Maybe they think this stuff's going to get worked out. Don't know. But as of this Monday, the traders are coming back into the market, and you got 300 points higher there. Again, 6.63 was where we ended the week on the 30-year fixed, and that is a near year-to-date low. Okay, tomorrow, little surprise event, totally free. Tomorrow at, I think, 3 p.m. Yeah, 3 p.m. Join Sharon Srivatsa, BAM board member, and Andrew Undum for a bulletproof pricing strategy masterclass. Okay, tomorrow, 3 o'clock Eastern time, 12 Pacific. Go to BAMX.ai, I think is the link. Haley will link it up, but go to BAMX.ai. And, well, maybe not. BAMX.ai / free listing pricing strategy masterclass. Just go to the link down below. Haley will get you set up on that. So if you want to sign up, totally free masterclass, how to overcome the biggest pricing worry, keep clients confident, 3 pricing mistakes that'll cost you listings, step-by-step framework for setting up the right price every time. Nobody's better at frameworks than Sharon. 5 most common agent pricing errors and how to fix them. A simple way to adjust prices automatically as the market shift. Totally free tomorrow, 3 o'clock Eastern time. Sharon, Andrew Undum, bulletproof pricing strategy masterclass, kind of a pop-up free masterclass. Told you there's a lot of good stuff coming with Sharon being BAM board member for the BAM community. BAMX members, obviously, you guys have the access now to Sharon's productivity playbook right inside of school. BAMX members go to Sharon's classroom right here, Sharon's knowledge bank, and the productivity playbook is uploaded. All the new content each and every single week is uploaded right here inside of the new this week classroom, as well as all the slides. Now it is August, so just toggle over to August here on the left-hand side. Every slide that we use here on the hot sheet uploaded each and every single day. Just one click of the button, you can come up here on the app or on the desktop and download that for your text communications, as well as all of our notes. Of course, our partners over at Zudelio are giving their platform included in your BAMX membership. And they're also giving us great data like this. Top 10 housing markets for cash offers for the past week were as follows: Denver, Vegas, San Diego, Marietta, Georgia, Lakeland, Florida, Phoenix, Jacksonville, Atlanta, Orlando, and Houston. It's your top 10 housing markets for cash offers over the last week. All BAMX members get a Zudelio platform included in their BAMX membership. Go to school.com/BAMX to make sure that you get your spot locked in. You can try it for 7 days. All right, there's your kickoff for the week here, the hot sheet. I'll see you guys back here tomorrow morning. Until then, of course, toodaloo.